Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
After listening to today's news, you'll know, first, US signals direct intervention in Argentina's crisis, using its rare exchange stabilization fund to counter China's influence. So we'll discuss why this signals a new model of US intervention and what it means for emerging market debt and the geopolitical balance. Second, India's $18 billion bet on mature node chips could trigger a global supply glut and anti-dumping actions from the US and Europe. We'll examine how India's weak intellectual property laws may impact its ambition to become a credible China plus one alternative for Western firms. Third, TikTok's algorithm to be rebuilt for 170 million US users under Oracle's watch, creating a new algorithm fork regulatory precedent. This discussion will reveal how isolating the US algorithm from global data could degrade user experience and threaten the platform's advertising revenue model. The United States just declared that all options are on the table to stabilize Argentina's escalating financial turmoil. In a direct message, US Treasury Secretary Scott Bessent called Argentina a systematically important US ally, signaling a potential intervention that has sent ripples through global markets. And that phrase, all options, is more than just diplomatic language. You see, the US Treasury has a powerful and rarely used tool called the Exchange Stabilization Fund, or ESF. Think of it as the Treasury's own emergency reserve, established back in the 1930s, that allows it to intervene directly in markets without needing anyone else's approval. By mentioning this, Secretary Bessent is signaling that the US is ready to use its own money to stabilize an ally's economy, potentially creating a new model of intervention for countries aligned with an America First policy. This comes as Argentina's economy is in freefall. The peso is plummeting while investors are dumping Argentine stocks and bonds. The crisis is so severe that Argentina's central bank burned through $1.1 billion of its reserves in a single week, just to prop up its currency. That move has put the country in an even more precarious position to pay back its debts. However, if you zoom out, you'll see another layer of strategy at play. While grappling with this crisis, Argentina has also been leaning on support from China. In fact, just last year, Argentina used its currency swap line with China to pay back part of its debt to the IMF. That's right, using yuan to pay back the US-led IMF. This shows how China is expanding its financial influence in America's backyard. So this US rescue mission isn't just about economics. It's a strategic move to counter China's growing presence in Latin America. But that's not the whole picture. The real turning point is that the US government is now considering direct market intervention, including outright purchases of Argentine pesos and the country's dollar-denominated government debt. Now, the reason this is a big deal is that it isn't a standard bailout. It's a real-world experiment in what some are calling backdoor dollarization. Essentially, the US Treasury would be using its credibility to anchor the Argentine peso, stabilizing it without forcing Argentina to officially adopt the US dollar. If it works, it could become a new playbook for other nations struggling with currency crises. This high-stakes move is a major test for Argentine President Javier Milei, a libertarian ally of US President Donald Trump, whose radical cost-cutting agenda is facing intense pressure. The key here is a concept called moral hazard. While this US promise of support, what traders might call the Milei put, can calm markets and lower Argentina's borrowing costs in the short term, it also creates a risk. If Argentina's government believes the US will always be there to bail them out, they might be less committed to making difficult but necessary fiscal reforms in the long run. This is especially critical ahead of the country's midterm elections. The core conflict is clear. Milei is fighting a political battle at home, grappling with local election losses and a bribery scandal, while simultaneously securing a monumental financial lifeline from Washington. All eyes are now on an upcoming meeting between President Trump and Milei, where the full details of this rescue plan are expected to be announced. So, what should we watch for next? The upcoming meeting will be critical, as it could force other countries in the region to think about who their financial partner is. The US and the IMF, which often come with political conditions, or China's alternative financing model. For a real-time market signal, keep an eye on Argentina's credit default swaps, or CDS. A falling CDS spread would indicate that investors believe the US rescue plan will work, while a rising spread would signal growing fear of a default. This dramatic US pledge follows a $20 billion loan Argentina already secured from the International Monetary Fund in April. The message from Washington is clear. The financial rescue for its key Latin American ally is now entering a new and far more direct phase. We were just talking about the US countering China's influence, and that global competition is also playing out in the high-stakes world of semiconductors. The most unexpected news on that front today has to be India's $18 billion bet to build a global chip powerhouse from scratch. In a world scrambling for semiconductor self-reliance, India, one of the largest consumers of electronics, has virtually no local chip industry. Now, it's making a monumental push to change that. Actually, building a semiconductor industry is incredibly complex. It's not just about one or two giant factories. It requires what experts call a full-stack ecosystem. This includes everything from the specialty chemicals and gases needed for production to the equipment manufacturing and a highly skilled workforce. The Indian government has approved 10 major projects, backed by a total investment of 1.6 trillion rupees. The crown jewel is an $11 billion fabrication plant led by Tata Electronics, part of a bold ambition to create a full supply chain on Indian soil. Let's zoom in on this massive fab, which is being built in Dholera, Gujarat, and aiming for a capacity of 50,000 wafer starts per month. This is a huge undertaking. The real sign of success won't just be the shiny new factories, but a boom in local companies making specialty chemicals and components. That would signal a truly sustainable industrial base, not just a temporary bubble fueled by subsidies. They're trying to capture a piece of the market shifting away from China and secure their own strategic supply. So the thing is, India's strategy has major implications for the global market. Its approach appears to focus on what are called mature nodes. These are slightly older chips, like those in the 28 nanometer to 90 nanometer range, which is still the backbone of the automotive and industrial sectors. This is a smart way to enter the market, but it comes with a big risk. By subsidizing this type of production, India could, within 3 to 5 years, contribute to a global supply glut, which would depress prices. This is almost a mirror image of China's past industrial strategy, and it could eventually trigger anti-dumping investigations from the US and Europe. However, there's a significant hurdle. One expert warns that India needs more than just a few shiny objects. Leading chip makers consider as many as 500 different factors before committing to a multi-billion-dollar plant, from unshakable infrastructure to ironclad intellectual property laws. And that's no exaggeration. For context, the US Chamber of Commerce publishes an annual international IP index. In its 2024 report, India ranked 43rd out of 55 major economies. By comparison, the US and UK hold the top spots. This is a critical barrier because without confidence that their core designs and trade secrets are protected, global tech giants will be hesitant to move their most valuable research and development activities to India. And the reality check is stark. While India celebrates its first major fab projects, Taiwan's TSMC is already set to begin mass production of cutting-edge 2nm chips later this year, a technology generation ahead. Interestingly enough, because of this steep climb, a more immediate and viable entry point for India might be in a different part of the supply chain. OSAT, which stands for Outsourced Semiconductor Assembly and Test. Think of this as the final stage packaging and testing the chips. It's less capital intensive than building fabs from scratch and offers a much quicker path to generating revenue. A key development to watch will be the growth in India's OSAT sector, as this could be its fastest route to becoming a credible China plus one partner for Western firms looking to de-risk their supply chains. Even with a deep pool of engineering talent, the situation presents a fascinating duality. On one side, Indian engineers are designing chips for global giants, but on the other, the most valuable intellectual property is often held in the US or Singapore. As one legal partner put it, the competition isn't just about money, it's about the entire ecosystem. The final verdict on this high-stakes gamble will depend on whether India can compete not just with factories, but with the established power of nations like the US, Europe, and Taiwan. Speaking of the tech rivalry with China, it's not just about hardware supply chains, it's also about controlling the software that runs on them. And a seemingly impossible situation is now becoming a reality. TikTok's famous algorithm is about to be completely rebuilt from the ground up just for America. Here's where it gets interesting. This forced separation of an algorithm is a new regulatory tactic, sometimes called an algorithm fork. It goes beyond just requiring data to be stored locally. It fundamentally changes the software's core logic just for one country. Now, get this, it sets a powerful new precedent. It could trigger other countries to demand similar audits from US tech companies, potentially accelerating the trend of a splinternet, where your internet experience becomes fragmented and different depending on which country you're in. Under a multi-billion-dollar deal stemming from the Trump era, the technology that determines what 170 million US users see in their feeds will be copied. Then it will be retrained using only US user data. Tech giant Oracle is stepping in as the gatekeeper. The company, which already holds US user data under an arrangement called Project Texas, will now gain unprecedented access. Oracle will audit and inspect the very source code and recommendation system that underpins the entire app. It's a comprehensive role designed to secure the platform for American users. Believe it or not, this move perfectly aligns with Oracle's bigger strategy. The company is carving out a niche for itself as the go-to provider for what's called sovereign AI or sovereign cloud. These are ultra-secure cloud services that guarantee a country's sensitive data stays within its borders under its own laws. By becoming the trusted guardian for TikTok's US data and algorithm, Oracle gains a massive competitive advantage and a powerful case study to win more government and regulated industry contracts, putting it in a unique position against rivals like AWS and Azure. And this isn't a simple sale to a single buyer. A new joint venture, also involving private equity firm Silver Lake, will take control of US operations. White House officials state this new entity will be seeking patriotic investors and board members with cybersecurity experience to oversee the platform, with a 120-day enforcement pause to allow the deal to close. This idea of patriotic capital is itself a new model. It blurs the line between a private company and state interests. By design, it could distort normal market competition and how capital is allocated, as companies with this government-approved status might receive preferential treatment. What really brought this to a head, though, is the potential for this to backfire spectacularly. Analysts are sounding the alarm. According to Jasmine Enberg, principal social media analyst at eMarketer, material, or even perceived, changes to the content, algorithm, or app policies could prompt massive shifts in user behavior. She warns that if a US-only algorithm cuts American users off from global content, it could degrade the user experience. And she has a point. A social media algorithm's strength comes from the sheer volume and diversity of data it learns from. By cutting off the US algorithm from the global data pool, it might become less effective at predicting what users want to see, limiting the discovery of new trends and content. A less engaging feed means users are likely to spend less time on the app. In the world of social media, user engagement is everything, and a drop in engagement could directly lead to lower advertising revenue, threatening the economic viability of this politically driven solution. This high-stakes maneuver is a complex answer to long-standing national security demands. The deal is structured to save TikTok's presence in its most valuable market. But this deal isn't just up to the US. After all, China has its own set of rules. In response to foreign restrictions, China updated its export control list to include technologies like AI-based recommendation algorithms. This means the core technology that makes TikTok so successful may not be transferable without Beijing's approval. A hardline block from China would be a major escalation in the tech conflict. Therefore, a key focal point to watch is whether China's Ministry of Commerce will approve this technology transfer. It's a gamble that risks fundamentally breaking the viral cross-border engine that made the app a global phenomenon in the first place.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.